History of selling VIX options. Let's do it. So since last Monday, the price action in equities and the sudden jump in volatility, the VIX index has once again come under the spotlight. Volatility on volatility has been crazy the last couple of weeks, last 2 weeks. So I think that's a very fair statement. From Monday, August 5th to today, what is today, the 16th?
Today is the 15th.
15th. So from the 5th, actually it was the Friday before, so it would be 4th, 3rd, 2nd. From the 2nd to the 15th, it's been kind of crazy. Those spikes in volatility, these spikes in volatility are good for premium sellers looking to put on new positions after the fact. But during the squeeze, existing positions and accounts are tested to the extreme. And it would be completely unfair for us to say that that was easy in the least. It was not. It was incredibly difficult. We got squoze just like everybody else. It was impossible to avoid the squeeze. Since 2010, if you sold premium in the VIX, what do you think the average performance was? And what was the worst case loss when the VIX skyrocketed? Now, I have to put a little disclaimer out here. Tony and I never sell VIX premium. Have we sold puts in VXX? Of course. Have we sold call spreads in VIX and VXX and UVXY? Of course. But generally speaking, we don't sell premium by selling the VIX. Generally speaking, we sell premium in individual indexes and things like that, or individual equities. We don't really use the VIX that much. Occasionally we'll trade VIX futures. Occasionally we'll do stuff in the VIX, but we don't really sell a lot of VIX premium. I don't love the liquidity in there. It's okay. It's just the markets are wide. But what do you think the worst case loss since 2010? We're wiping out 2008. But for the last 14 years, if you sold VIX premium, what do you think your worst case loss would be? Just a one lot strangle.
5,000?
5,000? It's not a big guess.
I'm just guessing.
You don't make that much money on it. So it's like,
No.
Yeah. So Tony says maybe 5,000. And he has no idea. I had no idea either. I mean, there's no way you would know this. So since 2010, if you sold 25 Delta Strangles, 45 days to expiration and managed at 21 days, that's what we're checking. We calculated the average P&L, the win rates, and the average credit received, worst case, also worst case. We repeated the same study for just selling puts and calls only when the VIX was above 20, like it got to last week. So on average, selling VIX calls, because there's no premium in the puts, and VIX strangles was profitable and obviously had the highest tail risk. Selling VIX puts was a break even at best. So even though the VIX collapses, seems like it collapses, most of the time. 20% of the time the VIX contracts, 70% of the time it's in a collapsing or lull state, 10% of the time it rallies. So even though it goes down, the puts are priced accordingly. That's how efficient the markets are. The puts have no premium. So selling puts never worked. Your average P&L is a negative number for selling puts. When we sell puts, we try to sell them not in the VIX, but we'll sell them in like VXX where there's a little more premium, but it's a really hard trade. Selling puts in volatility, hoping that you get a pop in volatility by selling puts, very, very hard game to play. The flip side of it is that how about selling 25 Delta calls or 25 Delta strangles? Both of those were profitable, but again, the average P&L is a little bit lower in the strangles than it is in the calls. The credit's higher in the strangles, but the actual P&L is a little higher in the calls. The win rate's about the same, and the worst case in these cases was $1,500, okay, on a 1,900, so it's almost 8 to 1, 9 to 1, 10 to 1, whatever it is, in that range, all right? So that's since 2010. When selling premium in high VIX scenario, that's VIX over 20, the win rates increase, the credit goes higher, but the worst case scenario does not change. And so that's interesting. So what happens here is the 25 Delta strangles, we went from like $189 to $317 in credit. The 25 Delta calls went from like 125 to 177. The worst case stayed the exact same, and the average P&L jumped. The puts still lost money, and the win rate went up significantly. You do much, much better when implied volatility is higher when you sell premium in the VIX. Again, the biggest problem here is that the worst case loss is significantly higher than the average credit received. Now, or than the average P&L. One thing to note about the study's worst case loss, it showcases the worst final trade P&L, but does not take into account what happened. And here's the whole key to this thing. It does not take into account what happened over the last 10 days. So for example, if we had done this study in 2024, we would have had a situation where we sold a strangle in the VIX. We were down a crap load of money, but because it's all just for study purposes, we've already come all the way back down. this trade probably would have been shown as a winner.
Positive, right. Mm-hmm.
When in the interim, you would have probably been forced to cover.
Sure.
So that's why some of this is not fair. If a naked VIX position is taken through the vol spike, in other words, this time the vol spiked to, let's say, 38. Earlier in 2020, the vol spike was to 80. The marked open P&L may force the account into a margin call. So the real risk of a naked short VIX call is not just the final P&L, but also the worst case marked P&L, which can be over $6,000 per one lot. You said 5, you were pretty close. It's actually 6. So if the VIX spikes from wherever it is around 20 to 80, the loss, it's just simple math because it's $1 a point, is $6,000 on a one lot, which puts a lot of people into a difficult situation because you obviously at some point are probably going to cover that position. You are not going to ride it all the way back down to 20.
$175, it's a hard hold.
It's a hard hold. So, the most you can make, again, was $175. Now you're down $6,000. You're not loving that position at any stretch, so you're not going to hold it. So that's why some of these numbers, when you look at this, you're like, well, what's the biggest risk in the VIX? I put up, I can make $175 or I can make $313 with a high VIX. And the biggest risk I'm going to have is $1,500. That's a great CVAR. But the reality is that's not really fair because the actual CVAR, it can be the actual loss can be way worse in the middle of the trade. So since 2010, selling strangles and calls in the VIX was profitable. Selling puts on average was a break even at best. And here's the key though. Although the worst case losses tend to be roughly 8 times the initial premium, they do not take into account the open P&L that can occur. Realistically, if you open a strangle when the VIX is 15 and it spikes to 80 during the trade, your worst case mark-to-market P&L can be over $6,000 per one lot. So it's not 8x. In this case, you're making 100, whatever that is. It's almost 40.
It's huge.
Yeah. Like you said, when you realize what you stand to make, that's the challenge of this position. What's the workaround? Well, the workaround is you do a wide call spread. So if you did a wide call spread, now you make less money. But if you do a wide call spread on the call side, and because you want to sell calls in the
Those call spreads trade so cheap. I mean, they trade for 10, 20, 30 cents.
No, but this time you're doing one that's $17 to $20 wide.
Okay, go ahead.
Here, let's take a look right now. Go to the 25 delta call. Just go to the 25 delta call because you're going to go to your CVAR number.
Okay.
So you go to the 25 delta call and then go 20 strikes higher. That's your CVAR.
25 delta call.
Short the 25 delta call. Now go 20 strikes higher.
Okay.
Because that's your CVAR, the most you can lose.
Sure. 53 cents. Okay. I mean.
That sucks.
Yeah. I mean, you're not making that trade.
Well, no. The difference is that if you did it the other way, you're getting $175 and you're risking the same amount.
No, you're risking $6,000 versus $1,950.
No, I know, but the CVAR is the same. That's all I'm pointing. All I'm doing. One of the things that I've learned.
A lot of play on words here. This is an untradeable product. I agree.
I
don't like this.
One of the things I want.
Who did this market measure off with their head? Who did this?
Anton. No.
Oh, Anton. You really are on my last nerve.
One of the things I want to say about this, which I think is important, if you're ever curious how to do a synthetic strangle, okay, or a synthetic naked call or put, what you should do is you can look and see what the CVAR is. That's your worst case 5% of the time, okay? And whatever the CVAR is, like in this case, it was 1,700, right? That's how wide you make your strikes or right around there. Because essentially what you're doing is you're creating a pure synthetic play by using defined risk. Like people will do defined risk, but then they'll just pick an arbitrary number, like let's say $5 or $10 wide. But it's not really a synthetic play unless you go to the same CVAR number. Then you have the true synthetic on.
Okay. I don't know why everybody loves the VIX so much. It's the dumbest product I've ever seen for retail investors.